Hello and welcome to Verico Academy. This program is entitled Commercial Mortgages, the Basics. The objective of this program is to train non-commercial brokers to recognize a potential commercial mortgage and refer to or co-broker with a commercial broker, thereby diversifying and increasing revenue stream for the mortgage broker. What is a commercial mortgage? It's the loan that uses commercial real estate as collateral. There's different types of commercial mortgages. First, there's the basic commercial mortgage, which would include the purchase or refinance of a loan that has commercial real estate as security. Next, there's construction commercial mortgages, which involves the building of houses, townhouses, condo buildings, commercial or industrial or specialty properties. Land development commercial mortgages is when there is development from land. More information on that later on. Subprime commercial mortgages are when an applicant and or the property don't qualify for your prime commercial mortgages. The different types of property that you'll find on a commercial mortgage: industrial, multifamily, which is townhouses or single-family home developments, high-rise and mid-rise residential properties, rental apartment buildings, shopping centers and office space, retirement and nursing home developments, mixed-use property, which is when you have the retail on the main floor and the residential directly above it. Student housing developments and raw land are also included. There's some key points to remember when you are presented with a commercial mortgage application. First of all, commercial mortgages are based on cash flow, not on loan to value. The DSCR, or debt service cover ratio, is something we'll talk about a little later on. Commercial lenders don't pay broker commissions. In fact, they charge fees. So the commercial brokers need to charge the fees in order to get paid. Full documentation is required up front. You don't wait until you get a commitment. You need to supply the documentation at the very beginning. Rates are determined after reviewing the file, and the rates are based on the file itself. You shouldn't order an appraisal in advance. You don't order an appraisal until the lender advises you, and they generally want to order the appraisal. The process in general takes several weeks. It's much longer than a residential mortgage application, which you would consider 24-48 hours to be the turnaround time on that transaction. With a commercial mortgage, you can expect it to take weeks, maybe even months. Let's talk a little bit more about rates. The rates that are charged on a commercial mortgage will be based on the deal itself, and they will not be determined until after the deal is underwritten. Many things will come into consideration by the lender: the property type, the use of the property, the cash flow, the DSCR calculation, and the covenant. A little more about fees. The lender will charge their own fee, and then you as a broker need to charge your own fee as well. We recommend that you quote to your client a total fee, which would include both the lender fee and your fee. Amortization on a commercial mortgage generally runs 20 to 25 years. You can go as high as 35 years on a CMHC insured apartment building. On the appraisals, as mentioned, you don't order an appraisal in advance. Generally, the lenders like to order the appraisal themselves, and they have a very short list of approved appraisers that they will accept an appraisal from. The commercial property appraisals are much more expensive than on residential property. On average, they will range from $1,500 to $2,000. However, they can go as high as $5,000. It is dependent upon the location of the property and the type of property that is being appraised. On down payments, the CMHC insured apartment buildings require 25% down. They'll advance up to 85% of the value of the property. However, the CMHC value is found to be less than what the appraised value is. On conventional mortgages, 65% is the maximum loan to value, therefore 35% down payment is required, and the lender will insist that they are able to verify the down payment. As mentioned earlier, these mortgages are approved based on cash flow, and the calculation for the cash flow is called the DSCR, or the debt service coverage ratio. A DSCR of less than 1 indicates that there's not enough cash flow to cover the loan payments. Generally, the lenders will require 1.15 to 1.35 as the DSCR. The formula is the net operating income divided by the annual debt service. Here is the formula itself. It's the annual net income plus expenses that are shown on the financial statement but are not actually paid out. For example, amortization, depreciation, and it's divided by the principal repayment plus interest payments plus any lease payments for the DSCR. We're going to talk a little bit about a cap rate or direct capitalization. This isn't something that you would normally have to calculate when you are looking at a commercial mortgage. However, if you're dealing with commercial realtors, it is a term that they use, and it's important that you understand their terminology in order to relate to them. So the cap rate converts the property's annual income into an estimate of the value of the property. The cap rate will deduce the property's propensity to be profitable and the length of time in which a commercial property will actually pay for itself. You divide the annual net operating income of the property by its sale price or its current market value. Here's the formula. Calculating the net operating income is something that you should know how to do regardless of whether you're going to calculate the cap rate or not. And here's an example of how to calculate it. The potential gross income is taken, which is the scheduled rents, any other income. So for example, it could be on an apartment building that the owner may rent out parking spaces or may have additional income because of laundry facilities that are used. You take all of that and it becomes your total potential gross income. And from that, you deduct vacancy and collection losses anticipated. And that will give you the effective gross income of the building. From that, you take the operating expenses. You will have fixed operating expenses, variable expenses, and a replacement allowance that equals your total operating expenses. And you subtract one from the other, which gives you your net operating income. So effective gross income minus total operating expenses equals your net operating income. We'll discuss financial statements a little further on, and you'll be able to see where you can get this information from. And here's an example of a cap rate calculation. The net operating income is $100,000. The value of the property is $2 million. You divide the net operating income by the property value, and it equals 5% cap rate. Therefore, in this example, the property will generate its purchase value in 20 years, 100 divided by 5. Financial statements. The financial statements are a formal record of the financial activities of either a business, a person, or another entity. There's 4 basic components to financial statements. The first one is the balance sheet, or statement of financial position. Then the income statement, the statement of comprehensive income. Those two are the ones that are used the most in what you do. Then there are the changes in equity and also the statement of cash flows. Larger companies with more complex report may include notes to financial statement, which explains things that they have done in the financial statement. Let's talk a little bit about the balance sheet. The balance sheet is the only one of the financial statement which applies to a single point in time of the business calendar year. It's like at that time they have taken a snapshot report of the assets, liability, and the ownership equity. The net worth of the company equals the assets minus the liability. The income statement. It's also known as the profit and loss statement, revenue statement, earnings statement, operating statement, or statement of operation. It represents a specific period of time, and it shows how revenue or money from sale of products and services before the expenses taken out transforms into your net income. Here's an example of the income statement. You can see there's revenue here and expenses here, and then you have below the line items, so anything that is not included in either one of those two, to give you your final net income. It details revenues for a specific period of time and costs and expenses that are charged against the revenue. This in itself will show you if the company has made or lost money during the time period reported. So it's also important for you to notice up here that this is the time period. Cash flow statements. The cash flow statement reports the cash that's generated and used during the time interval specified. The cash flow statement allows the investor to understand how a company's operations are running and where the money is coming from, and then how it is being spent. Usually a cash flow statement will be broken down into areas such as operating activities, investment activities, and financing activities, as you can see here. Let's talk a little bit about the different types of commercial mortgages. We mentioned them at the very beginning of this program, but now we're going to tell you a little bit more about each. The construction commercial mortgage. It involves construction of a new or existing property. And what you need to know when you're looking at this type of a mortgage application is what's being built. Is it a house, townhouse, condo building, commercial, industrial building, specialty building, for example, a nursing home? And what is the expected final value? Also, you need to know what the expected total cost of the construction is and any related expenses. So, for example, there could be other costs, soft costs, such as permits, reports, and consultants. You need to know what the value of the land is, if it's owned, and any existing debt on that land. And are there any sales in place, or is this a project which is based on speculation? Development commercial mortgages. This involves land which is going to be developed into a residential subdivision or a condo building or a shopping mall. First, you need to know where it's located. Then, you need to know what the existing zoning is and the value of the property. You need to have an anticipated final value and goal regarding zoning. For example, is it a subdivision, commercial tower, and so forth. You should also know what the expected costs are and if there's any existing financing on the land at all. Subprime private commercial mortgages. This would involve commercial and construction mortgages which are turned down by the banks or the prime lenders. It would consist of first and second mortgages. Those people that have unique property or a unique property situation, your client that has poor credit but good cash flow, or a lower DSCR could be accepted on a private mortgage. The borrower needs time in order to turn themselves around from having been a private commercial mortgage client to being a prime mortgage client. The other time you may find that you need to use a subprime private commercial mortgage lender is if the client requires very quick turnaround time. You'll find that a private lender can provide faster turnaround time than other lenders. Now we'd like to talk to you about a checklist that we have prepared to help you and to guide you when you're looking at a commercial mortgage application. This commercial mortgage checklist can be found on this site, and it's a good idea for you to print it and actually use it when you are looking at a commercial mortgage application. It tells you everything you need to consider before either referring it to or co-brokering it with a commercial broker, as they'll require this information. When you're dealing with the client, if you're going to be referring it or co-brokering it, you need to advise them of this. Tell them that you're going to refer to a commercial broker who specializes in commercial mortgages, and in using them, they'll get the best product for their needs. Also, you should advise your client that you're going to need the documents up front and what documents they are. Refer to your checklist for this information. You need to advise them that fees are going to be charged, and as soon as you know, you will let them know what those are. And the same with the interest rate, that you can't advise them at this time what that rate will be. You could give them an approximate based on your own knowledge or experience, but advise them that both the fees and the interest rate are dependent upon the deal itself, the client as the covenant and the property as security. If you're looking for commercial mortgage brokers that you want to refer to or co-broker with, you should go to the Verico intranet, select SharePoint, select from the SharePoint the contact directory, which is on the far left-hand side, and under there you'll see commercial mortgage brokers. Select that, and there's a current list there of all of the commercial mortgage brokers in the Verico network that are happy to receive your referrals or to co-broker with them. Thank you for joining us today, and good luck with your commercial mortgages.